Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Shanghai Electric Group Co. Limited Annual Report. Shanghai Electric Group Co. Limited offers a diverse range of businesses and services across various sectors. In the energy sector, the company provides equipment for nuclear power, energy storage, coal-fired power generation, gas power generation, wind power, hydrogen, photovoltaic, and high-end chemical production. In addition to energy equipment, Shanghai Electric also manufactures industrial equipment such as elevators, large and medium-sized electric motors, intelligent manufacturing equipment, and construction industrialization equipment. The company's integrated service business segment offers a range of services including power grid and industrial intelligent power supply system solutions, energy and environmental protection engineering, automation services, and industrial internet services. Furthermore, Shanghai Electric provides financial services such as financial leasing, factoring, asset management, and insurance brokerage. The company also offers park and property management services, making it a comprehensive provider of various businesses and services. Shanghai Electric Group Co. Limited, market capitalization of 129 billion, is significantly larger than the average industry peer of roughly 16 billion. This shows that Shanghai Electric Group Co. Limited holds a significant advantage in their industry. Shanghai Electric Group Co. Limited trades at a higher price-to-earnings ratio of 42 times and a lower price-to-book ratio of 0.95 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that investors are already valuing the industry with a forward premium for the industry, leaving limited opportunity to uncover undervalued stocks. The leverage on the balance sheet appears elevated, with liabilities of 75% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of the extracted summaries. On one hand, several factors have contributed to revenue growth. New orders, particularly in the energy equipment sector, have been a significant driver of growth, with sales revenue from coal-fired power generation business experiencing substantial increases. Additionally, operating revenue has seen a 10.8% increase, while sale of goods and leasing income have also experienced notable growth. Furthermore, finance lease income has grown by 18.2%, indicating a strong demand for financial services. On the other hand, several factors have led to revenue decline. Sales of raw materials have declined by 28.4%, while engineering construction in other regions has also seen a significant drop. The industrial equipment segment has experienced a 1.5% decline, and rendering of services has decreased by 5.6%. Other areas have also seen declines, with a total decrease of 11.5%. These factors highlight the importance of diversifying revenue streams to mitigate potential losses. The net income of a company has seen significant growth, with an increase of 14.6% and a year-over-year rise of 60.3%. This substantial improvement can be attributed to various factors that have positively impacted the company's financial performance. In terms of profit margins, there are notable changes across different segments. The operating and total profit margins have increased from 3.2% to 3.9% and 4%, respectively. However, a closer look at the gross profit margins reveals mixed results. While the energy equipment segment has seen an increase of 1.3 percentage points, the industrial equipment segment has experienced a decline of 0.5 percentage point. On the other hand, the integration services segment has witnessed a significant rise of 2.6 percentage points in its gross profit margin. These changes in net income and profit margins can be attributed to various factors such as improved operational efficiency, increased revenue, or strategic decisions made by the company's management. The mixed results across different segments suggest that the company is focusing on specific areas for growth and improvement. The financial health of a company can be gauged by its ability to generate positive operating cash flow. Unfortunately, the current situation for this particular company is concerning. According to recent analysis, the company is not generating sufficient operating cash flow. This lack of positive operating cash flow indicates that the company's expenses are exceeding its revenues, resulting in a negative cash balance. This can be a sign of underlying financial issues that need to be addressed. To rectify this situation, the company may need to reevaluate its cost structure, improve operational efficiency, or explore new revenue streams. The absence of positive operating cash flow poses significant challenges for the company's long-term sustainability and growth prospects. It is essential for management to take immediate action to address these issues and implement strategies to generate a positive cash flow. The company's debt level and interest expenses have undergone significant changes in recent times. A notable decrease in short-term debt is observed, with a reduction of RMB 547 million. This decline indicates that the company has successfully managed its short-term liabilities, reducing its financial burden. On the other hand, long-term debt has seen a slight increase, rising by RMB 151 million. While this may seem concerning, it is essential to consider the context and overall financial health of the company. The decrease in interest expenses from RMB 98,265 to RMB 72,806 suggests that the company's ability to manage its debt has improved, resulting in lower interest payments. Overall, these changes indicate a shift towards more manageable debt levels and reduced financial obligations for the company. The performance of various segments within the energy sector has been mixed. On a positive note, energy equipment has shown strong performance, indicating a growing demand for this type of equipment. In contrast, industrial equipment has struggled, suggesting that this segment is facing challenges. Notably, integration services have maintained a neutral stance, neither experiencing significant growth nor decline. This suggests that the market for these services remains stable. The remaining segments, including coal-fired power equipment, nuclear power equipment, wind power equipment, and energy storage equipment, do not appear to have been significantly impacted in terms of revenue growth or decline. Management is emphasizing the company's strategic direction, highlighting several key areas of focus. The primary objective is to drive industrial upgrading through strategic planning, which will enable the company to stay competitive and adapt to changing market conditions. Technological innovation and deepening reform are also crucial components of the company's strategy. By embracing new technologies and implementing reforms, the company aims to enhance its core competitiveness and improve overall efficiency. This approach will not only drive growth, but also position the company as a leader in its industry. The ultimate goal is to build a world-class equipment manufacturing group, which requires cultivating new quality productive forces and leveraging technological advancements to achieve significant leaps in competitiveness. By achieving this vision, the company will be well-positioned to succeed in an increasingly globalized market. The company has demonstrated its commitment to returning value to shareholders through various means. One notable example is the payment of dividends. For the year 2025, the proposed final dividend per ordinary share stands at RMB 0.01425. In addition to paying dividends, the company has also engaged in share buybacks. Specifically, it repurchased a significant number of shares, totaling 39,687,456 units, for a total payment of RMB 299,977.7 thousand. This strategic move aims to enhance shareholder value and potentially boost stock performance. That concludes the financial summary for Shanghai Electric Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.